Tell your dog the walk is delayed. He'll survive. Your understanding of this market might not. Yesterday, they tried to slam it into the floor. Today, it came back like it took that personally. That V shape on your screen, that's not normal behavior. They tried to halt it. They tried to smash it. They tried to scare you out of your position with a flash crash yesterday. But today, the market gave its answer. And the answer was a violent vertical explosion to the upside. If you are looking at your screen, you are witnessing one of the most aggressive V-shaped recoveries in the history of the silver market. Silver is currently trading at $93.65. That is a gain of $6.54 on the day. That is a surge of 7.51% in a single trading session. We have erased the entire drop from the CME halt. We have erased the fear from the cash settlement rumors. And we are now knocking on the door of the final resistance level at $94. If we clear 94, technical analysts suggest the path toward the triple-digit psychological level becomes significantly clearer. Why is this happening? Why did the market turn so violently on a Friday afternoon? Because you can halt a computer, but you cannot halt reality. And the reality hitting the tape today is a perfect storm of geopolitical escalation and inflationary data. We have received breaking news regarding the situation in the Middle East that has triggered a massive flight to safety ahead of the weekend. According to verified reports, the U.S. State Department has authorized the voluntary departure of non-emergency U.S. government personnel and family members from missions in Israel. Simultaneously, we are seeing reports that China is advising its citizens in Tehran to take safety precautions or leave the region. While these are precautionary diplomatic moves, the financial markets interpret them as a signal that the risk of escalation has risen significantly. Traders do not want to be short gold or silver over a weekend when headlines like this are crossing the wires. They are covering their shorts, they are buying protection, and they are driving the price of safe haven assets vertical. Gold has responded in kind. It is trading up $57 at $5,234. But silver is the more volatile asset. Silver is the asset that moves fastest when the panic sets in. Yesterday, the narrative was that the rally was over because of a trading halt. Today, the narrative is that the rally is just beginning because the world is becoming more dangerous. This confirms what we have said for months. The price of silver is no longer just about industrial supply and demand. It is about geopolitical insurance. When embassies start reducing staff and when bomb shelters are reportedly opening, nobody cares about the open interest on the COMEX. They care about owning an asset that has no counterparty risk. But it isn't just the war drums driving this move. We also have a massive economic catalyst that hit at 8:30 this morning. The Producer Price Index, PPI, the measure of wholesale inflation, came in hot, very hot. The expectation was for a 2.6% increase. The reality was a 2.9% increase. Core PPI jumped to 3.6% against an expectation of 3.0%. This destroys the narrative that inflation is under control. It destroys the narrative that the Federal Reserve can cut rates aggressively without consequences. With inflation accelerating, the market appears to be shifting out of cash and into hard assets. That is why we are seeing this panic buying. The smart money is looking at the weekend risk. They are looking at the inflation data. And they are deciding that $94 silver is cheap compared to the alternative. We are watching the $94 level closely. This is the line in the sand. If we close above $94 today, it signals that the shorts have completely lost control. It signals that the CME halt was their last desperate card and it failed. The market has absorbed the selling, absorbed the manipulation, and ripped higher anyway. This is the definition of a bull market. A bull market climbs a wall of worry. And right now, that wall is very high. In the next part of this deep dive, we are going to look at the hard data from the COMEX. Despite the rumors of cash settlements yesterday, we have confirmed that 22.7 million ounces of silver stood for delivery today on first notice day. We will break down exactly who stopped those contracts. Hint, it wasn't the retail public. It was the biggest banks in the world. Citigroup and JP Morgan are taking delivery. Why are they taking metal if they are supposedly the ones suppressing the price? We will explain the game they are playing. While the retail traders were watching the war headlines, the institutional giants were watching the warehouse receipts. We just witnessed one of the most significant first notice days in recent history, and the data that just dropped from the CME group completely destroys the narrative that nobody wants physical silver. Remember the rumors yesterday? Remember the cash settlement panic that supposedly wiped out the open interest? Well, it turns out that not everyone took the bribe. It turns out that a massive contingent of contract holders looked the bankers in the eye and said, "Keep your fiat currency. Give me the metal." Here are the hard numbers. On first notice day for the March contract, a staggering 4,540 delivery notices were issued. Let's do the math on that. 4,540 contracts times 5,000 ounces per contract. That is 22.7 million ounces of silver standing for delivery in a single day. To put that in perspective, the total registered silver inventory at the COMEX, the metal available to be delivered, is sitting around 88 million ounces. That means in one single morning, claims were made on more than 25% of the entire available stockpile. 1/4 of the vault was effectively spoken for before lunch. But the real story is not how much was taken. The real story is who took it. Usually we assume it is industrial users or wealthy individuals taking delivery. But look at the clearing report. The entities stopping the notices, meaning the entities taking possession of the metal, are the biggest banks in the Western world. Leading the pack is Citigroup. Citigroup stopped 1,624 contracts for their house account. That means they bought over 8 million ounces of silver for their own book. They didn't buy it for a client, they bought it for the bank. Then look at Bank of America. They stopped 820 contracts for their house account. That is another 4 million ounces. And then there is JP Morgan. They stopped 749 contracts. Why does this matter? Because for years, the conspiracy theory was that these banks were the shorts. The theory was that they were the ones suppressing the price to keep the dollar strong. But today, on a day when silver is ripping 7% higher to $94, these banks are not selling. They are buying. They are taking massive physical delivery. This is a capitulation signal of the highest order. It tells us that the banks know the game is up. They know that the cash settlement scheme yesterday was just a delay tactic to let them get their own house in order. They settled the speculators with cash so they could take the physical metal for themselves. It is a classic bait and switch. They scared you out of your position at $86 so they could buy the physical bars at $90. Think about the implications for the vault. If 22 million ounces leave the registered category this month, we drop from 88 million down to roughly 66 million ounces. We are inching closer and closer to that operational zero we discussed. And remember, this is just the first day of the delivery cycle. There are still thousands of contracts open. March open interest dropped by 4,300 contracts today, but less than half of those rolled to May. That means there are still over 2,000 contracts, another 10 million ounces, that are sitting in limbo, potentially waiting to demand delivery later this month. This creates a floor under the market. If Citigroup is willing to buy 8 million ounces at these prices, do you think they're going to let the price crash back to $50? No, they are now invested. They have physical inventory on their balance sheet. They are now positioned to benefit from the same upward price momentum as retail holders. The largest institutional players have now gone long. And when the banks go long, the structural resistance to higher prices is removed. This delivery data explains the ferocity of today's rally. The shorts, who didn't cover yesterday, are looking at this report. They see Citigroup taking the metal. They see the inventory draining. And they realize there is no backstop. There is no secret vault of silver coming to save them. The only way out is to buy back their short positions at $93, $94, or whatever the market demands. This is a squeeze driven by the big boys against the smaller hedge funds. It is a transfer of wealth from the paper speculators to the physical owners. In the next part of this deep dive, we are going to pivot back to the fundamental drivers. We need to talk about the hot PPI number again. Because while the war news grabs the headlines, the inflation data is the engine that keeps this train moving for the next 5 years. Inflation at 2.9%, when they told you it would be 2%, is a disaster for the bond market. It means real interest rates are falling. It means the Fed is trapped. And it means that gold and silver are the only honest scorecards left. We will connect this inflation data to the massive structural change happening in India with the sebi mandate. Because while US banks are buying silver to trade it, India is buying silver to keep it forever. We have covered the escalating geopolitical tensions in the Middle East. We have covered the bank heist happening at the COMEX vaults. But now we need to talk about the silent thief that is driving this entire move. The thief that doesn't need a trading halt or a delivery notice to steal your wealth. We are talking about inflation. And this morning, the thief got caught red-handed. At 8:30 a.m., the Producer Price Index, the PPI, was released. The market was expecting a cooling number. They were expecting 2.6%. Instead, they got a scorching 2.9%. Core PPI, which strips out food and energy, jumped to 3.6% against an expectation of just 3%. Why does this matter to the price of silver? Because it proves that the Federal Reserve has lost the battle. For 2 years, they told you inflation was coming down. They told you they could cut rates because the beast was tamed. Today's data proves the beast is alive, angry, and growing. When wholesale prices rise by nearly 3%, those costs get passed on to you. They get passed on to the consumer. And when the market realizes that inflation is accelerating while the economy is slowing, that is the textbook definition of stagflation. In a stagflationary environment, stocks struggle, bonds get crushed. But commodities? Commodities soar. This is why silver is up 7%. It isn't just a geopolitical risk hedge, it is an inflation hedge trade. Investors are realizing that if they hold cash over the weekend, it buys less on Monday. If they hold bonds, the yield is being eaten by inflation. So they are rapidly shifting capital into the only asset that cannot be printed. They buy gold and silver. But while the US is struggling with inflation, India is making a move that effectively weaponizes it against the paper market. We need to do a deep dive into the regulatory change coming out of Mumbai. We mentioned earlier that SEBI, the Indian regulator, is changing the rules for mutual funds, but we need to look at the specific details because they are revolutionary.
Starting April 1st, 2026, sebi is mandating that mutual funds must use domestic spot prices from Indian exchanges for valuing their gold and silver holdings. They are explicitly replacing the LBMA price. For decades, India used the London price adjusted for duties. Now they are saying, no, we will use the price discovered in India. This decouples the physical Indian market from the paper London market. If demand in India is high, which it is, with record inflows of 240 billion rupees in January alone, the domestic price in India will rise above the London price. And because the funds have to mark their books to that higher price, it creates a massive incentive for arbitrage. It creates a vacuum cleaner effect. But here is the kicker. SEBI is also allowing multi-asset allocation funds to hold up to 35% of their portfolio in precious metals. 35%. Previously, these equity funds had very strict limits. Now, a fund manager in Mumbai looking at a crashing stock market can legally take 1/3 of his massive portfolio and dump it into silver ETFs. He can dump it into gold bars. This brings billions of dollars of passive flows into the market. This is money that buys regardless of the price. It buys because it has to allocate. It buys because it needs safety. So connect the dots. In the West, we have hot inflation driving investors out of bonds and into metals. In the East, we have a regulatory mandate driving funds out of London paper and into domestic physical metal. You have a push from the US and a pull from India. And sitting in the middle is a silver market with a massive deficit. This is why the price is ripping to $94. The fundamentals are aligning perfectly. The shorts are fighting a war on two fronts. They are fighting the US inflation data on one side and the Indian demand on the other. And judging by the price action today, they are losing on both fronts. In the next part of this deep dive, we are going to look at the immediate technical picture. Silver is trading at $93.65. We are approaching the $94 resistance. We will tell you exactly what happens if we close the week above $94. Technical analysts are now watching for a move toward the psychological triple-digit level. We will also discuss the possibility of a gap up on Sunday night. With the Israel evacuation news hitting the wires and the Chinese citizens leaving Tehran, market uncertainty regarding the geopolitical situation is at a multi-month high. Traders know this, and they are pricing in a war premium before the market closes. We have analyzed the inflation data. We have analyzed the massive physical delivery demand from the banks. We have analyzed the structural shift in the Indian market. Now we have to look at the chart. Because right now, at this very moment, the price of silver is fighting a battle at a level that could define the next 6 months. We are trading at $93.65. We have touched $94 in the session. Why is $94 so important? Because it is the last line of defense for the shorts. It is the final trendline resistance from the previous consolidation. If we close the week, today, Friday, above $94, technically speaking, there is no structural resistance until the all-time highs near $120. It becomes open air. The algorithms that use moving averages and Fibonacci levels will flip from sell rallies to buy dips. They will chase the momentum. And look at the context of this move. Usually, a 7% rally in a single day is met with profit-taking. Traders sell into the close to lock-in gains. But today, we are not seeing profit-taking. We are seeing panic buying. We are seeing traders adding to their positions into the close. Why? Because of the news we discussed earlier regarding Israel and Iran. When the U.S. State Department authorizes voluntary departure from an embassy on a Friday afternoon, it is not a coincidence. It is a signal that their intelligence suggests something could happen over the weekend. When China tells its citizens to leave Tehran, it is a signal that they expect retaliation. Traders know this. They know that if we see a major military escalation over the weekend, gold and silver will gap up 5 or 10% on Monday morning. They remember what happened when the conflict started. They remember the gaps. And they are terrified of being short or being in cash over the weekend. This creates a war premium. The price of silver is not just reflecting supply and demand today. It is reflecting the option value of holding a safe haven asset during a potential geopolitical crisis. It is insurance against chaos, and right now, the cost of that insurance is rising every minute. If you are holding physical silver, you are holding a claim on stability in an unstable world. If you are holding paper shorts, you are holding a stick of dynamite with a lit fuse. The $94 level is the trigger. If it breaks, the move toward the $100 psychological level could accelerate quickly. We also have to consider the psychological impact of this move on the retail investor. For weeks, the narrative was that the rally was over because of the CME halt. But today's price action proves the bull market is alive and well. When retail investors see silver up 7% on CNBC, when they see gold making headlines again, they come back. They start buying coins. They start buying ETFs. And in a market as small as silver, even a small increase in retail demand can squeeze the physical premiums higher. We are already seeing reports of queues forming at bullion dealers. Bullion Star reported massive demand this morning. If the price breaks $94, that trickle becomes a flood. In the final part of this deep dive, we are going to synthesize all of this into a clear strategy for the weekend. We are going to tell you exactly what to watch for on Sunday night.
If we see news of escalation in the Middle East, expect a gap up. If we see calm, expect a consolidation. But the trend is clear. The banks are buying, the funds are buying, the public is buying, and the only people selling are the ones who are forced to buy the broken mechanics of the paper market. This brings us to the end game for the week. We have dissected the massive 7.5% explosion in the silver price to $93.65. We have analyzed the verified reports of U.S. and Chinese evacuations in the Middle East that are driving a flight to safety. We have exposed the hot PPI inflation data that proves the Fed has lost control. And we have broken down the staggering 22 million ounce delivery demand at the COMEX, led by the very banks that were supposed to be short. Now, as we close the books on Friday, February 27th, 2026, we need to synthesize all of this into a clear strategic outlook for the weekend and the Monday open. Because while the West is going to sleep, the East is just waking up to a new reality. The perfect storm has arrived. You have war risk. You have inflation risk. You have counterparty risk. And sitting in the middle of it all is silver, the most undervalued asset on the planet. Here is the strategic briefing for the next 48 hours. Step 1. Watch the geopolitical wires. The news regarding the U.S. Embassy in Israel and the Chinese warnings in Tehran is critical. Markets hate uncertainty. If we see any escalation over the weekend, any significant geopolitical development or official declaration, we could see a massive gap up in gold and silver when futures reopen on Sunday evening. We saw this when the conflict began. We saw it during the tariff announcements. If you are holding physical metal, you are insulated. Holding cash in this environment carries significant purchasing power risk. However, everyone's financial situation is different. Always consult with a professional before making major moves. The $94 level is the key resistance to watch. If news breaks, we could see a gap above $94, potentially setting the stage for a move toward the $100 psychological level. Step 2. Watch the India bid. For our viewers in India, this SEBI mandate is the game changer. The new rules allowing mutual funds to allocate up to 35% to precious metals and forcing them to use domestic spot prices starts a structural bull run that will last for years. It means that every time the stock market wobbles, billions of rupees will flow into gold and silver. It means the Indian floor under the price is now made of concrete. This is not hot money. This is generational wealth entering the market. While the U.S. worries about the Fed, India is quietly cornering the physical market. Step 3, ignore the paper volatility. The banks might try to slam the price again next week to cover their tracks. They might try to paint the charts red to discourage the retail public. But remember the 22 million ounces. Remember that Citigroup and JP Morgan took delivery today. They are buying the dip. They're buying the rip. They're buying everything because they know the paper game is ending. If the banks are taking physical possession, you should too. Do not let them shake you out of your position right before the repricing event. Finally, I have a request for you. We track this data every single day, the delivery notices, the embassy alerts, the inflation prints, because the mainstream media will not tell you the truth about sound money. They will tell you the economy is strong while inflation eats your savings. They will tell you peace is here while embassies evacuate. If this analysis helped you cut through the noise today, if it helped you understand why silver ripped 7% when everyone said it would crash, please hit the like button. It helps us fight the algorithm and wake more people up. And if you haven't already, please subscribe. We are building a community that is prepared for the wealth transfer that is happening right now. We are witnessing a major shift away from the paper standard toward a resource-based standard. In this new world, he who holds the gold and he who holds the silver holds the power. The weekend is here. The risk is high. But the reward for being on the right side of history has never been greater.